Hi, everyone, and welcome to the latest edition of the MAI Market Update. I'm John Zauler, CIO of MAI Capital, here to discuss the all important topic of rising interest rates and how they're impacting our viewpoints on asset allocation and the economic cycle. Following their recent leg higher, interest rates across the maturity spectrum are now higher than at any time over the last decade. The implications of this new environment are varied. It's great news for savers and investors with large cash balances now that they can find money market funds yielding around 5%. But not such great news for borrowers looking to make that next home or business purchase with much higher short and long term financing costs. How long this higher interest rate regime will last is a key question to consider. One approach to answering this question is to try to decipher the Fed's neutral rate for monetary policy, or in other words, the Fed funds rate that's neither accommodative nor restrictive for the economy, and where it's likely to settle out for the long run. As shown in the chart on your screen, the Fed's current projections suggest the Fed funds rate will return to a neutral rate of 2.5% over the next 3 years, down from its current level of 5.375%, implying several rate cuts from the Fed as there's less need to fight inflation. But market indicators are suggesting that the neutral rate may be higher than the Fed anticipates. One such market indicator is the 5-year forward Treasury rate, which measures expectations for the 5-year Treasury yield 5 years from now, and is considered a proxy for the market's view of the neutral rate. As you can see, this rate is now suggesting that the neutral rate will settle in near 4% on a longer term basis versus the 2.5% the Fed dot plot is predicting. If the market's correct, we're in for a higher for longer interest rate environment, and that has implications for investors. First, with respect to asset allocation, a higher interest rate environment changes how we should think about the relative attractiveness of equities versus bonds. If an investor can now earn 5% plus with limited risk in high quality bonds, they should require an adequate premium for having to stomach the volatility of equity markets. One way to visualize this is by looking at the equity risk premium, taking the earnings yield of the market, which is the inverse of the market's PE ratio, which is now close to 20 times, and subtracting the 10-year Treasury yield. As you can see, the current adjusted earnings yield, or in other words, the premium available in equities, is down to just 1% over bonds, below the long-term average of 1.9% going back to the 1980s. And that's not to say equities can't perform well in times of a lower risk premium, as they did in the decade of the 1990s, but it required a major expansion in valuation that eventually reverted back when the tech bubble deflated. What it does say pretty clearly is that the risk reward in bonds has improved relative to equities. And this is especially important considering the potential impact of today's interest rate environment on the economic cycle. It's not simply that interest rates are higher, but it's the shape of the yield curve that indicates an over-tightening of monetary policy and a tougher economic environment ahead. As shown in the chart on your screen, the yield curve is as inverted as it's been since the high inflationary period of the late 1970s and early 1980s, which is the last time the Fed has really had to tackle an inflation problem. In each case of an inversion between the 2-year and 10-year Treasury since then, a recession followed within 2 years. We're now 17 months into the current yield curve inversion, so in some ways, it feels like the clock is ticking. One indicator we'd be watching closely is the data on weekly unemployment claims, as a sustained rise in claims would be the first sign of a weakening in the labor market and the overall economy. While we do expect to see recessionary conditions in the next 12 months, it may not be severe enough to cause a significant downturn in equities. Nonetheless, we believe investors can now earn adequate returns in safe assets, making us more inclined to take a modestly cautious stance tactically, while staying within reach of each client's long-term strategic allocation target. After all, investing successfully for the long run requires holding on to a properly diversified portfolio through economic cycles in order to not miss out on the upside that often materializes well before the outlook improves. Ensuring we stay focused on the long run helps to avoid emotional decisions at the wrong time and positions us to capture the long-term returns your financial plan is built upon. As always, we greatly value the opportunity to serve you as your trusted advisor and provide the peace of mind of knowing we are always looking out for your best interest and positioning you to achieve your long-term goals. If you have any questions regarding our thoughts on today's video or your portfolio in particular, please feel free to reach out to your wealth advisor at any time. Thanks so much for listening, and we'll see you next time.